Welcome back to the Deep Dive. Today we're looking at a company you've definitely seen, probably everywhere, but maybe haven't really thought much about. Cintas Corporation, ticker CTAS. Think clean uniforms, those mats by the door, the first aid kits on the wall. Cintas is behind all of that. Our mission today, to really pull back the curtain on this, well, the sort of quiet giant, some call it a Buffett-Style compounder. It turns these everyday necessities into just a fortress of free cash flow.
And just so everyone's on the same page, all our analysis today is based on the market close of October 29, 2025. Cintas stock closed that day at $183.90 per share.
Okay, and right off the bat, here's the puzzle, the real tension. The business itself, I mean, it seems to be firing on all cylinders.
Absolutely. They just beat earnings estimates, they raised their full-year guidance, and the board announced this massive new buyback authorization, another $1 billion.
Bringing the total to $1.7 billion authorized for repurchase. Huge signal. But, and this is the big but, you look at the stock chart, and it's flashing some pretty serious bearish technical signals. It's trading well below its 50-day moving average, even further below the 200-day.
So that's the core question we're tackling. Is the market just overreacting here? Maybe spooked by wider macro fears? And this is actually a chance to buy a quality company a bit cheaper.
Or is the chart telling us something the financial reports haven't shown yet? Is there some weakness coming down the pike that the market's sniffing out?
Let's dig in. First things first, what exactly does Cintas do?
All right, Chapter 1, Business Analysis. The model itself sounds almost boringly simple, right? Route-based, recurring revenue.
Simple, but incredibly powerful when executed well. Think of it like a subscription service, but for essential business operations, delivered by their huge network of trucks and facilities.
Predictable.
Very predictable. Let's break down where the money comes from based on fiscal year 2025 data. The absolute behemoth, 77.1%, that's from uniform rental and facility services.
So the core uniforms, mats, towels, that kind of thing.
Yeah, exactly. Then you've got 11.8% from first aid and safety services. Think those wall-mounted kits, defibrillators, eye wash stations, stuff that's often legally required.
High retention there, I imagine.
Definitely. Compliance drives that. And the final 11.1% is lumped into all other. That's mostly their fire protection services and some direct sales of uniforms.
Okay, so the core is really that rental and facility services piece. And the advantage comes from scale.
Scale and infrastructure. It's massive. They serve over 1 million businesses. Think about that.
Wow.
And they do it with roughly 12,100 local delivery routes. That route density is key. Supported by nearly 478 operational facilities, warehouses, laundries, service centers.
So it's like a logistics company that happens to handle uniforms and safety gear.
Pretty much. And that dense network creates a really significant competitive advantage, what we call an economic moat. It comes down to high switching costs for customers.
Right, those contracts.
Yeah, standard contracts are typically 5 years, and they usually have automatic renewal clauses baked in.
5 years is a long time to be locked in.
It is, and if you try to terminate early, there are substantial financial penalties, usually calculated as your average monthly payment times however many months are left on the contract.
Ouch. So it's not just inconvenient to switch, it's actually expensive.
Extremely expensive and disruptive. So customers tend to stay put. They become sort of embedded.
Okay, sticky customer base. But where does the growth come from? Are they just poaching customers from smaller players?
That happens, sure. But here's a really interesting statistic from Cintas. They find that 60% of their new business comes from customers who were not previously using any kind of rental program.
Ah, so they're converting businesses that used to maybe buy their own uniforms or handle safety supplies internally.
Exactly. It points to this bigger secular trend of businesses outsourcing non-core functions. Cintas isn't just fighting for existing market share, they're actively expanding the size of the entire market for these services.
Okay, strong foundation, expanding market. Let's talk leadership. Chapter 2, Management Evaluation. The CEO, Todd M. Schneider, he's basically a Cintas lifer, right? Started as a management trainee way back in 1989.
Yeah, over 3 decades with the company. That kind of tenure often signals a deep understanding of the business and usually a very long-term owner-like perspective. It's not just a job for these guys.
So with that kind of culture, how do they handle the company's money? What's the capital allocation strategy look like?
It seems very shareholder-focused, following a pretty clear hierarchy. Priority 1 is reinvesting in the core business to maintain and widen that moat.
Makes sense. Got to keep the machine running.
Right. So in fiscal 25, they put $408.9 million into CapEx. That's new trucks, facility upgrades, technology, maintaining that scale advantage. Plus, they're not afraid of bolt-on acquisitions, spending $232.9 million on M&A in FY25.
Okay, reinvestment first. What's second?
Returning capital to shareholders. Aggressively. We already mentioned the buybacks, but let's not forget the dividend. Cintas is a dividend aristocrat, meaning they've increased their dividend payout every single year since they went public back in 1983. That's a 42-year track record.
42 years. That's impressive consistency.
It really is. And then you layer on the buybacks. In FY25, they repurchased almost $680 million worth of shares. And now, with that new $1 billion authorization, they have a total of $1.7 billion approved for future buybacks.
That is a significant chunk of change relative to their market cap. It does signal management thinks the stock is cheap right now.
It certainly seems that way. It's a strong signal of confidence in the future cash flows.
But okay, the ultimate test of management isn't just returning cash, it's how efficiently they generate it in the first place, right?
Yeah.
How good are they deploying the capital they keep?
Exactly. And the best metric for that is return on invested capital, or ROIC. This tells you how much profit they generate for every dollar invested in the business operations.
And for Cintas.
It's exceptional. In fiscal year 2025, their ROIC hit 27.0%.
27%. Wow.
Yeah, and get this. Just 4 years prior, in 2021, it was 18.1%. So they've massively improved their efficiency. That 27% ROIC puts them in truly world-class territory among public companies.
Okay, that level of efficiency definitely justifies some kind of premium valuation. Let's get into the financials more deeply. Chapter 3, Financial Analysis. Top line first. Revenue hit $10.34 billion in fiscal 25. That was up 7.7% year over year. Pretty solid growth for a company this size.
It is solid, steady growth. But the real story, I think, is on the profitability side, the margin expansion. It really signals they have pricing power.
Okay, give us the numbers.
Their gross margin is 50.0%. Half of every revenue dollar is gross profit. Operating margin came in at 22.8%, and net profit margin was 17.5%.
You said those are improving, even with inflation pressure.
Yes, they've managed to improve margins, citing things like better energy efficiency in their laundries and optimizing production. They're really leveraging that scale effectively.
And all that profitability translates into cash flow, I assume.
Oh, yeah. This business is a prodigious generator of free cash flow, FCF. Over the 12 months ending May 31st, 2025, they produced $1.757 billion in FCF.
And just to remind listeners, FCF is the actual cash left over after all the bills are paid, including maintaining their assets. This is the cash they can use for dividends, buybacks, acquisitions, or just piling up on the balance sheet.
Exactly. It's the lifeblood. But now we have to address the elephant in the room, the valuation.
Right. Despite all these great fundamentals, the moat, the ROIC, the FCF, the stock trades at a trailing price-to-earnings ratio, PE, of about 42.2.
Which is steep by almost any historical or comparative measure.
Let's put that in context. Their main direct competitor, UniFirst ticker UNF, trades at a PE of only 21.0.
Literally half the multiple.
So why the huge difference?
Well, this is where that quality metric, the ROIC, comes back into play. The market is paying a premium for Cintas' superior quality and efficiency. Remember, UniFirst's ROIC, it's only 6.9% compared to Cintas' 27.0%.
Okay, so Cintas is objectively a much higher quality business, generating far better returns on the capital it employs.
No question. The debate for investors is whether that quality justifies paying double the earnings multiple. Is the premium too rich right now?
And when you try to figure out the intrinsic value, maybe using something like a discounted cash flow model or DCF.
Yeah, it gets tricky fast. The estimated value becomes highly sensitive to your assumptions, especially the growth rate you plug in for future cash flows. Historically, they've been in the 7-12% range, and current guidance is 7.5% to 8.5%.
And the discount rate you use also matters hugely. That's the return you require for taking the risk, usually somewhere around 8% to 10% for a stable large cap like Cintas.
Slight changes in either of those inputs can swing the calculated intrinsic value quite a bit. It just highlights that at a PE over 40, there isn't a huge margin of safety based on typical modeling assumptions.
Okay, let's shift gears and look outside the company. Chapter 4, Market Sentiment. What's the general feeling about Cintas on Wall Street?
Generally positive, but maybe not overwhelmingly bullish. The consensus rating tends to hover around moderate buy or sometimes neutral.
And price targets.
The average 12-month price target from analysts is around $225 per share. Compared to the current price of $183 per share, that suggests potential upside of over 22%.
So analysts, on average, see value here.
And the recent news flow has been very supportive too, right? We mentioned the Q1 FY26 earnings beat back in September, the raised guidance, the dividend hike, that big buyback news.
All objectively good news, which makes the stock chart even more puzzling.
Exactly. That's the technical disconnect we talked about up front. That stock price, $183.90, is sitting significantly below its 50-day moving average, which is around $200.80.
Not great.
And it's even further below the longer-term 200-day moving average at $208.54. For technical analysts, those are pretty clear bearish signals suggesting near-term weakness or downward momentum.
But there's a counterpoint on the technical side.
A small but potentially important one, short interest is very low. Only 1.77% of the float is sold short.
Meaning not many sophisticated investors are placing big bets that the stock price is going to collapse.
Correct. So it leaves you, the investor, in this position. Do you trust the strong fundamentals, the positive news, and the analyst targets? Or do you heed the warning signs from the technical chart patterns? It's a classic conflict.
Let's see if ownership gives us any clues. Chapter 5. Ownership structure? Who actually owns Cintas stock?
Well, institutions hold a very large chunk, 70.95% of the company. And the biggest holders are the giants, the passive index funds like Vanguard at 9.55% and BlackRock at 7.00%.
Which means the stock price can be heavily influenced by flows into and out of broad market index funds, not just company-specific news.
That's right. But there's also significant insider ownership, which is generally a positive sign. Total insiders own 14.95% of the shares.
And that's mostly the founding family.
Largely, yes. It's anchored by the former CEO and current chairman, Scott Farmer, who personally holds about 14%. That's serious skin in the game, aligning the long-term family interest with other shareholders.
Okay, that long-term family stake feels like a big positive. But I remember seeing some headlines about recent selling.
Yes. And here's where we see a bit of a conflict. While that huge family stake provides long-term stability, if you look at the transactions over the last 6 months or so.
Okay, starting with the opportunities, we touched on this, but the potential market seems huge.
It really does. Cintas currently serves about 1 million businesses in North America, but the estimated total number of businesses that could use their services is around 16 million.
Wow, so they've only penetrated a small fraction of the potential market.
Exactly. Massive untapped potential there. Plus, even with their existing million customers, there's huge potential for cross-selling.
Selling more services to the clients they already have.
Yes. Apparently, their penetration rate for selling additional services like first aid or fire protection or restroom supplies to their existing uniform rental customers is generally below 20%. So big runway for organic growth just within their current customer base.
Okay, massive market, lots of cross-selling potential. What about the flip side? The threats. What keeps Cintas management up at night?
The biggest one is probably macroeconomic, a significant recession. Cintas serves businesses, so if businesses suffer, Cintas suffers. Layoffs mean fewer uniforms needed. Bankruptcies mean lost customers altogether. Their route density takes a hit.
It's fundamentally a cyclical business tied to employment and overall economic activity.
Absolutely. Then there's inflation. Even though they've shown pricing power recently, persistent inflation drives up their own costs, energy for the laundries, fuel for the trucks, labor, the cost of textiles and supplies. There's always a risk that cost increases could outpace their price hikes, squeezing margins.
And rising interest rates.
That hits on two fronts. It increases Cintas' own cost of debt, which could slow down future M&A activity, and it increases borrowing costs for their customers, which might make them cut back on hiring or expansion, indirectly reducing demand for Cintas' services.
Any other specific threats?
One that's maybe more recent is geopolitical. Remember those U.S.-imposed tariffs in 2025? A lot of textiles and uniform components are imported. Those tariffs directly increase Cintas' supply chain costs and put pressure on their gross margin.
Right. Lots of moving parts on the risk side. Okay, let's try to pull this all together. Chapter 7. Conclusion. Let's start with the bull case. Why would someone buy Cintas today, even with the high valuation and iffy chart?
The bull case rests squarely on quality and consistency. You have that structural moat from scale and switching costs. You have a torrent of predictable free cash flow. You have genuinely world-class capital allocation, proven by that 27% ROIC.
Plus the 42-year dividend growth streak.
Right, a testament to reliability. And you still have that huge growth runway, both in tapping the underpenetrated broader market and cross-selling to existing clients. It's a bet that quality wins out over time.
Okay, now the bear case. Why stay away, or maybe even sell?
The bear case is pretty much centered on two things: valuation and the economic cycle. First, that extreme valuation, a PE of 42.2, leaves very little room for error or disappointment.
Price for perfection, basically.
Pretty much. Second, there's the clear cyclical vulnerability. If we do hit a significant recession, or if inflation stays stubbornly high, this business will likely feel it, and that premium valuation could compress quickly.
And you throw in those caution flags.
Yeah, the recent insider selling by top execs, combined with those weak technical indicators on the chart, suggests that maybe the smart money is getting a bit cautious at these levels, anticipating some of those macro headwinds.
So the final assessment, it really comes down to a judgment call, doesn't it?
I think so. The investment decision right here, at $183.90, seems to hinge entirely on your conviction. Do you believe Cintas' superior quality, its moat, its management execution are strong enough to power through the very real macroeconomic headwinds that the market seems to be pricing in right now via that weak stock chart?
Quality versus cycle. Okay, before we wrap up, here's the provocative final thought we want to leave you with today. Think about this. Management seems confident, right? That 27% ROIC, the massive $1.7 billion buyback authorization. Given that confidence, what annual rate of free cash flow growth does Cintas actually need to deliver over, say, the next decade to justify today's premium stock price? And maybe more importantly, how much would even a moderate recession potentially derail that required growth trajectory? Something to chew on. All right, that's our deep dive on Cintas. If you found this valuable, please like and subscribe to Stock Analytics AI. For just $4.99 a month, you get access to our full playlist. That's 500 deep dive videos covering every single stock in the S&P 500.
And coming up next, exclusively for our members, we're tackling the NASDAQ 100. Plus, members can request deep dives on specific stocks. Just drop the ticker symbol in the comments section, and we'll get our AI analysis engine working on it for you.
One last important note.
Disclaimer. Please remember, this analysis was generated by an AI system. It's intended for educational and informational purposes only and should absolutely not be considered financial advice. Always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.